Welcome back. Earlier today, new home sales were reported. The monthly supply of new homes year over year down 28%. New one family homes sold year over year up 31%. New one family homes sold for sale down 5% over year. Now, here's the monthly supply of new houses. Now, what this is, and this is the black line, it's the ratio of new houses for sale versus new houses sold. So when the line goes up, it means that the new houses for sale is greater than the new houses sold. It means more homes on the market. Now, the red line is the S&P 500, and what we can see over time is that more or less there's an inverse correlation in the sense that you see, for example, April 2020, we see the red line, the SP 500, spike to the downside. At the same time, the ratio, the monthly supply of new homes, again, the number of homes for sale versus the ones that were actually sold spikes up, meaning that there's more homes on the market when the S&P 500 goes down. Now, conversely, when we see them in the stock market went to very, very high levels, S&P 500 near 4,800, we saw a spike to the downside, which means the number of homes for sale was less, relatively speaking, than the amount sold. It really is an inventory gauge. Now, currently, where we sit right now, and this obviously is updating through the end of July, S&P 500, not including the recent market weakness we've seen, was on a very strong trend to the upside. At the same time, the monthly supply of new houses, the ratio of houses for sale was down compared to those new houses that were actually sold. It shows us that there was a greater influx of supply, a lot of supply out there. One of the reasons we've mentioned this in the past is because of high interest rates, the rapid acceleration in interest rates has basically led a lot of potential sellers to sit on the sidelines. So home builders are actually scrambling in an environment of very low inventory. Here we see these are new one family houses sold, and this is in a multiple of 1,000s. That's the black line. Red line again is the S&P 500. Positive correlation here exists where when the stock market goes down, we see the one family home sold also goes down. It makes sense that during strong economic periods of time, more homes will be sold when stocks go up. And conversely, when stocks go down, less homes will be sold. It's just two different components of the same economy. Lately, we've seen very strong stocks through July. At the same period of time, new one family houses were sold. Now, does the recent stock market weakness, will this translate into a decline next month? Only time will tell. But certainly we have seen, not including today, but we have seen a pretty significant pullback over the past couple of weeks in the stock market. Here we see new one-family homes for sale in black versus the S&P 500 in red. And we see there's a strong, it's not an exact correlation. You see here the stock market hit highs late 2021, early 22. There was a little bit of a delayed effect in terms of the new one family homes for sale. Perhaps we see a little bit of a lagging effect because it takes time for homes to be listed, to go through the realtor process and, to actually for those potential sellers to make that decision. So it's not a one for one correlation, but there is a pretty strong relationship. Now, those were the actual dollar numbers. What we're going to look at now is the year over year. And the housing market, especially, has a very seasonal component to it. We compare this July to last July because July is a lot different than December, for example, in terms of the housing market. In a year, here the yellow line is the monthly supply of new houses for sale. This is year over year, comparing this July to last July. That's again in yellow. The black histogram bars represent the interest rates, federal funds rates, which is currently at the 525, 550 level. Now, we can see going back in time, 2011, 2012, with a period of very, very low interest rates. Of course, we were recovering from the 2008 financial crisis. Year over year, we had Well, basically a negative 10 to 20% increase. This sort of oscillated. But then we saw a period of higher interest rates take effect. And I think that really put a stall on the housing market. Again, there's a little bit of a delayed effect, but these higher interest rates really slowed down the housing market. Of course, everything was drastically affected by the COVID stock market crash of 2020 and economic turmoil, of course. And that's why we saw the monthly supply really drop. But that monthly supply, that was not only economic, so to speak, it was also a fact, a result that the entire economy stopped, that home builders literally could not build homes for, a certain period of time. So that number is somewhat skewed. It's not a pure reflection of economics. However, after that occurred, we had a period of very low interest rates and a lot of stimulus. A lot of money was pumped into the economy. And then we see all of a sudden an enormous monthly supply of new houses that were put on the market year over year, comparing February 2021 to February 2020. Of course, this line is also skewed to the upside because when we compare March of 21 to March of 2020, well, March of 2020 was right in the center of that COVID crash. So you're comparing a good recovery to a period of time in 2020 when everything stopped. So this spike up is somewhat skewed. So take that with a grain of salt. But the lesson, I think the important takeaway is now, we see interest rates, which did go up to around 2.5% in 2018, we're now over 5% in a very short period of time. Again, notice we had 0.25% interest rates in 2015, and it took between 2015 all the way to 2019 to go from almost zero to a little over two, 3, 4 years in a very short period of time from April 22 through present day, June 23, about 15 months or so. We've seen 0.25% interest rates turn into 5.5. That rapid increase in interest rates has really put a damper on the housing market. There's just so much less inventory, but I think home builders are seeing there's still resilience out there. But that could be changing. Here again, the black histogram bars is the federal funds interest rates. Here, the yellow line is the new one-family houses sold. This actually reflects number of homes sold. And there was an enormous spike up. This is on a year-over-year basis. Again, the line was somewhat skewed comparing it to the COVID years. But now we see on a year-over-year basis, July over 30% to the upside from July of this year to July of last year. Now, also, and we'll mention this with something else, but remember June of 22, last year, about 13 months ago, we had the beginning of the inverted bond markets, which is a representation, or not a representation, but the result of an unhealthy market condition. Maybe that plays a part into all this. But the number of homes sold July this year to July last year, as a result, I think in part to low inventory that really spiked prices higher. And we see a huge spike up. Will this last though? Speaking of new one family homes, these are the homes that are now for sale. Now, compare it again to the prior chart. This is the new one family homes sold. The homes sold July to last July, year over year, up over 30%. The homes sold. The homes for sale right now is much lower. And remember, at the beginning, we looked at the ratio of homes for sale versus the homes sold. This is the number of homes that are now for sale. And you can see we're in negative territory, around negative 5%. You compare this July to last July, there's a lot less homes that are available for sale. So when we look at the prices of homes, keep in mind, every market, it's supply and demand. The fact of the matter is there's a lot less homes for sale, especially taking into consideration the prior chart. New one family homes sold. We're selling a lot more this July to last July. Well, now that we've sold so many homes, how many are left? A lot less. New one family homes for sale, it's a lot less. We're negative territory. The last time we were in negative territory, well, it brings us back to 2020. So if this changes, by the way, if the home builders are able to respond, and it's a very interesting situation because let's say the home builders come out there and they build a ton of new homes in a very high interest rate environment. What if they find themselves in the unlucky position of not being able to sell these homes with all this extra inventory? It could really sort of snowball on itself. So I think the home builders, while they, of course, they want to respond to the demand and the lack of supply out there, maybe they're not moving very fast only simply because they see, what's out there, interest rates and the overall economic, climate. Now, speaking of economic climates, we look at these home numbers and the number of homes for sale. It's certainly, it can be considered a negative in the sense that there's a lot of consumers out there that maybe feel that they can't afford to get in a home with a low amount of supply. Well, there's the other side of the coin. There's a lot of numbers that say the economy is very strong. A lot of the numbers here we talk about don't agree with that. But the Chicago Fed's National Financial Conditions Index, which we'll call NFCI for short, is a weekly update of U.S. financial conditions in the money markets, including debt, equity markets, the traditional and also shadow banking systems. It really is a pure reflection of the banking system. And it's reported on a weekly basis, so this is much more timely. We're not looking back to July. Between July and now, things have changed. Positive numbers indicate the financial conditions are tighter than average. And again, this is looking at debt and equity markets, consumer loan markets, commercial banking markets, things of that nature. When the number's positive, it means things are tighter. They're more difficult. Equity markets are more difficult. The debt markets, it's more difficult to borrow. When we see negative numbers, we see that they're looser and easier. So negative numbers, just remember, are actually better. Well, the red line here is the S&P 500. This goes back to early August. This is this month. And this month, we went from a level of negative 0.36 to a level of negative zero point 0.4. Now, I know it's not a huge difference, but the trend, as I say, the trend is your friend. Well, the trend is showing that the equity markets and the debt markets and the shadow banking markets overall, putting all together, things are getting better. Now, I wonder how much this has to do with the rapid increase in yields in the 10-year bond. We spoke about this the other day, which has dissipated the inverted bond market. Now, we still have an inverted bond market. It hasn't gone away. But we went from 50 basis point, a 1.5% inversion. Now we're closer to a 1% inversion. Maybe does that have something to do with it? Maybe the way this, and I don't know, but maybe the way this is calculated, it takes a look at that dissipating, that weakening of the inversion. Maybe that's what's causing this number to reflect more positive outlook. Speaking of the bond market, here we go. The blue area chart in the background, that's the NFCI, the conditions index. Again, negative numbers show better conditions. The black line is a 10-year bond. The red line is a 1-year bond. And we can see, well, we had a massive inversion here. This started, by the way, June of 22. See when the red line crossed above the black? And we see this massive gap. Well, what's happened now? The red line has kind of found a ceiling over here. It doesn't seem to want to go much higher than 5.3% or so, because the red line, the 1 year, the short-term maturity bonds telling us, hey, the Federal Reserve may raise rates again, but we're pretty close to the end. But the black line, the 10-year maturity is rising. It's closing this gap. The inversion is weakening. And that's maybe telling us that the 10-year bond is accelerating because, they're selling the long-term bonds. You see, remember when yields go up, it actually means that bond prices are going down. They're selling the bonds now because they think maybe economic conditions will be better in the future. Or maybe we're just coming more towards a period of a condition of parity, where the short and the long term are once again approaching one another. Interesting though, when we had the biggest degree of inversion, when the 1 year was the furthest away from the 10 year, just not, maybe a few months ago, this this indicator, the NFCI, was much higher. It was almost in positive territory. And that's interesting how an inverted bond market seems to translate into a worse number. Now, when we compare the 1 and the 10-year bonds, you take the 10-year bond maturity, the yield, I should say, take the 10-year yield, subtract from that the 1-year yield, and you have the treasury spread. That's the 10-1 spread. That's the black line here. So when the black line goes up above zero, it means the 10's higher than the 1. When the black line crosses below zero, it means that the 1 is higher than the 10. And again, June of 22, when we cross below zero, that marked the beginning of the inverted bond market. Well, when the spread was at its highest point, and this reflects a healthy economic condition, 2021, relatively speaking, this NFCI was in a very low state, minus zero point 0.7. And again, a negative number means very good economic conditions. It really does look, and this is a guess, but it really does appear that this NFCI is very much linked to the condition of the bond market. When we have a healthy 10-1 spread, then we see a healthy reading on the NFCI. Negative numbers indicate looser monetary bond and debt and equity conditions. And it does make sense because if we think this out, if we have pretend we have a strong economy, we say, okay, well things are strong now, but things are going to be even stronger in the future. So what do we want to do? We want to buy stocks. We're buying stocks not based on their corporate earnings now, but based on the future, the expectation of future corporate earnings. We buy a stock now that's 20 cents per share earnings, but we think it's going to be 30 cents per share next year. They're going to increase their customer base, more sales. Buy the stock now. We hope it goes up. Well, that's how the bond market really does work because we say, okay, the 1 year bond's at, let's say, at 3%. The 10-year bond should be at a 4% because we say, well, if things are great now, things are going to be even better in the future. The trend is your friend. The trend's going up. And that's why the 10-1 spread, when it goes up, it's a sign. It's a result of a healthy economy. And when we have a healthy economy, the NFCI goes down. Now, compare and contrast this to 2020. This is not present day. This is 2020. The red line, the red histogram bar, that's the NFCI. The black line is S&P 500. We had that COVID stock market crash, March, April 2020. S&P 500 goes down. NFCI was in positive position, a positive zero point 0.4. As the stock market started to rally, and eventually crossed back above 3,000 in the S&P, this NFCI turned to negative territory. And we continue to go lower. Now, towards the end of 2020, we had a level of negative zero point 0.5, negative half. Keep that number in mind. This is where we are now. The S&P 500 is currently, 43-ish, 44-ish, in that area, between the 42 to 4,700 level. The NFCI is at a negative 0.45, roughly, right around that area. Where were we before? The stock market, the S&P 500 was at 3,400 and the NFCI was much lower. Not much, but it was significantly lower. My point being is that the NFCI looked better in 2020 despite a weaker stock market, relatively speaking. Now that the S&P 500, again, it was at 34, we're now at 44. The NFCI was at negative zero point 0.5. Now we're above negative zero point 0.5. So the NFCI, even though the S&P 500, if an apples to apples comparison, the stock market, the S&P 500 is up 1,000 points. The NFCI is actually in a worse position than it was in 2020. 2021. Now, it's not a huge difference, but I think it's worth, stating Wouldn't logic dictates that if the stock market, the S&P 500 is 1,000 points higher than it was in 2020 at 3,400, the NFCI at the time was around zero point 0.5 to the downside, 0.55. Now we're 4,400 on the S&P 500, but we're higher than zero point 0.5. Again, the negative number means conditions are actually better. Well, there's a little bit of a disagreement there. Now, who knows? Maybe there's a lot of calculations put in this NFCI, so maybe it's not fair to compare it on that basis alone. But I thought it was interesting to see that the stock market is very lofty, considering the fact that even though it looks like this NFCI is positive, well, it's good, meaning negative, which it is. Comparing it to August 2020, maybe not as much. Maybe also because you remember the Federal Reserve massively cut interest rates after that COVID stock market crash. So maybe the NFCI that period of time, that's really reflecting very, very low interest rates. Again, this measures the the degree of debt in equity markets and the ability to borrow money. So maybe that takes that into consideration as well. Nevertheless, we're going to watch this very carefully for any significant changes along the way. We hope this has been helpful. We look forward to seeing you back soon.